Joining the program now, all the way from Hong Kong, Jim Rickards. And Jim is a counselor, investment banker, and risk manager. He's got over 30 years' experience in capital markets. He's the senior managing director at Tangent Capital, which is a New York City-based merchant bank. He's also the senior managing director for market intelligence at Omnis Inc. He has written 2 books. His first one, Currency Wars, The Making of the Next Global Crisis, and his most recent book, which just came out, I believe, or no, it hasn't even come out yet. It's coming out in early April, competing with my book, which is also coming out in early April. It's The Death of Money, The Coming Collapse of the International Monetary System. I wonder if Amazon will pair the two together. That way you can get a good deal on both books. Jim, welcome to the show.
Thank you, Peter. Nice to be with you.
So what do you do? What's going on in Asia? What brings you from Connecticut to Hong Kong?
Well, I've got a couple of venues. You know, it's funny. The last time you and I met, we were in Santiago, Chile, and here I am in Hong Kong on my way to Australia. You're back in the States, but it's sort of a global format with the two of us. But I'm in Hong Kong as a keynote speaker at a Mines and Money conference, and that's got miners and investors from all over Asia. So obviously a lot of focus on Australia, but there are miners here from Vietnam, Indonesia, mainland China, of course, and all over the region. Actually here with our friend Jim Sinclair, who was on the panel with me this morning, and then heading down to Melbourne, Australia for an event hosted by Port Phillip Publishing called World War D. D is for devaluation, and has to do with kind of the death of money, which is the subject of my new book. And then I'll be over in Sydney for a few days. So making the rounds and back home to the United States in time for the book launch, and we go from there. So pretty busy schedule.
Yeah. So what is the mood out there at the mining conference? I mean, are they worried about the Goldman Sachs calls for sub-$1,000 gold on this great U.S. economic recovery and this hawkish Federal Reserve, or are people not paying too much attention to that?
Well, it's a really interesting question. I mean, it's been a tough, 2013 was a tough year for gold. We all know that, and it's been a very tough environment for miners. A lot of mining projects got green-lighted with gold at higher levels, or projected to be higher levels, and of course came down a lot. It's had a nice bounce since the end of last year. That's fine, but it's a tough industry. Capital's scarce, so it's a little bit of you say it's been a tough time for miners, but there's some good things happening lately. And as far as the Goldman Sachs call is interesting because I had a conversation with some Goldman Sachs people, and it was very interesting. Great chat over on the sidelines. And I said, what about that call? Because the people I was talking to were actually kind of bullish on gold. And I said, well, yeah, I agree with that, but what's up with this $1,000 call? And the way it was explained to me, they said, well, it comes from the research department, and they look at growth projections, and they look at, a path for nominal rates and real rates, and they do correlations and regressions involving the relationship of the nominal price to gold to real rates. So I said, stop right there. I said, I understand everything you're saying, but that's the Fed model. And he said, yeah, all our research department are like ex-Fed economists, and they use a Fed model. I said, but you're making growth assumptions I don't share. It has nothing to do with physical gold. And the guy kind of laughed. So I think it's a mistake to think of Goldman as this monolithic, what do they call it, the vampire squid or whatever. I mean, there are a lot of different moving parts inside Goldman, but I found some people more kind of feet on the ground on the commodity side who were disagreeing with their own research department. And when I drilled down on the research, I realized it's just a standard Fed model. Look, if you assume growth is going to be 4% and you assume that, inflation is going to tick up and real rates are going to be steeply positive, I mean, I agree that that's a tough environment for gold, but I don't share any of those assumptions. I've got growth, but lucky to be 2%, and the Fed is trying desperately to get negative real rates because they want to increase velocity. So, if you make a set of assumptions, plug it into a standard model, you're going to get a standard result. But I don't share the assumptions. But it was interesting to talk to people on one side of the house who disagreed with their own research. So that $1,000 call has everything to do with Fed models and nothing to do with actual gold.
Yeah, and as I said earlier, the Fed is basing its assumptions on a robust recovery, which we both agree is not going to take place. In fact, I think if the Fed were to actually follow through with the tightening that it has telegraphed, we'll be in a recession. And of course, what does the Fed do in a recession? It prints money and lowers rates. So it's impossible for the Fed to do what it's claiming it's going to do. And I don't know why anybody would pay any attention to it. But I wanted to ask you more specifically about your book, about the death of money. Is there a winner or a loser in the currency wars? And how exactly, how does this book, progress or build on your last book?
Thanks, Peter. As far as currency wars are concerned, they're the only way you win is by keeping out of them. If you jump into them, everybody loses because it's a race to the bottom in terms of devaluing your rates, and the way people do it is by cutting interest rates or quantitative easing to cheapen the currency. By the way, there's a myth out there that the reason countries like Japan or the U.S. try to cheapen their currencies is to promote exports so we can sell a few more Boeing aircraft, et cetera. That might be a byproduct, but the reason they're doing it, the reason Japan and the United States are desperate to do it, is because we want to import inflation. It's not about exporting manufactured products. It's about importing inflation. People forget that the U.S. is a net importer. We import more than we export. So you cheapen the currency, and we have to pay more for all those electronics and textiles and manufactured goods that will feed through the supply chain, so to speak. So that's
but Jim, although certainly, it's backfiring in Japan. Their terms of trade have worsened considerably, as I had forecast, as a result of the increased cost of imports. But that's not really importing inflation. You create the inflation domestically. When you debase your money, when you inflate your money supply, the source of inflation is at home. You're not importing the inflation. The fact that you're having to pay higher prices because you're paying for your imports with cheaper money, that's homegrown inflation. It's not imported. You make it yourself.
Well, in effect, look, I agree with that, Peter. But I always try to distinguish my own views from what policymakers think they're doing. And if you're trying to forecast policy, you need to sort of put yourself into their mindset. Now, that's a crazy world. I don't agree with any of the models or any of the assumptions the Fed are using, but I do try to explain how they think about things because that helps me forecast the path of rates, et cetera. But going back to your earlier point, I agree with you. The Fed has tapered into weakness, probably set up to cause a recession in 2014. I knew that they would taper more at the last meeting in March because it's Janet Yellen's first meeting as chair. She was sworn in January, at the end of January, but this was her first meeting as chairwoman. She wasn't going to walk into the room and blow up policy at her first meeting. They'll probably get another $10 billion of taper at the end of April. April 30th is the next meeting. But after that, and there's no meeting in May, I would look for a pause in June or July because I think then the data will continue to be bad. You'll no longer be able to blame the weather. I think the weather has very little to do with it, but be that as it may, the world seems to think that the weather's to blame. But once you get into June, you won't be able to blame the weather anymore. The data will continue weak. And the way the Fed operates, again, what I would do is kind of irrelevant because I try to focus on what actual policymakers are doing. They won't go from tapering to increasing asset purchases at one meeting because they do everything gradually. So what I look for in July is a pause where they'll just say, okay, we're going to print the same amount. We're not going to reduce long-term asset purchases. And then maybe by late this year, they actually will increase. I think that's the path.
Yeah. I think the minute they pause, though, you'll have like a $50 or maybe even a $100 increase in the price of gold. I think that's going to be a game changer because once they announce a pause, people are going to connect the dots to the expansion. And, if the data doesn't improve, we have gotten so invested in this, it's the weather. If we get, April and May numbers, and they're just as bad as January and February or worse. Now, all of a sudden, we have to go and take a second look at those January and February numbers and say, wait a minute, it wasn't the weather, it was real. The economy has been weak all this time, right? And the Fed was wrong because the Fed was blaming it on the weather, and they kept on tightening, even though they didn't realize that the fundamentals of the economy were deteriorating. So we're way behind the curve.
What happened, this morning, just before we went on the air, Case-Shiller, month-over-month, housing sales down, new housing starts down, prior month revised down, Richmond Fed and so forth. It's just a whole string of bad data. In addition to these weak employment reports that have been coming in, consumer confidence is up, but that's only because the stock market's up, and that's only because the Fed's printing money. There's nothing Wall Street doesn't like about zero interest rates. So, the other thing is you see leading indicators are up, but if you deconstruct leading indicators, one of the most heavily weighted components in leading indicators are stock market prices. So it's the blind leading the blind. You print money, you provide zero interest, there's massive leverage in the stock market. You get the stock market pumped up. That feeds into leading indicators. That feeds into consumer confidence. But that's all a house of cards.
Yeah, the other thing on the LEI that just came out last week, the other part was the steepening yield curve. But why is that? I mean, that's only going up because of what the Fed is saying. But to say that it's going up because it's indicating an economic recovery, no, it's not. It's just that's what the Fed is doing. So people are talking about a recovery, so they think it's going to happen, and so you get a steepening of the yield curve. But it doesn't mean the economy is actually improving. So yeah, I agree that the LEI is a bunch of nonsense. But all the real data. I mean, look at the jobs numbers. Look at the manufacturing, industrial production. Look at the the ISM numbers. These are all bad numbers, but no one cares because it's a little bit cold outside.
Right, and as far as we talked earlier about the Fed forecast and how that plugs into the Goldman Research Department model. That's where they get this $1,000. Well, no one has a worse forecasting record than the Fed. Every year they give a one-year forward forecast. So in 2009 they forecast 2010, 2010 they forecast 2011, and they do this every year. And you look at their forecast for the last 5 years, they were wrong all 5 years, and they were wrong by orders of magnitude. It wasn't like they were off a little bit. They say 3%, it comes in 1.8. They say 2.8%, it comes in at 1.5. I mean, they're not even close. And so when I see a rosy forecast from the Fed, to me that's a recession call.
Yeah, and in fact, not only are they always wrong, but they're always wrong in the same direction. It's not like sometimes they're too pessimistic and sometimes they're too optimistic. They're always too optimistic, which I believe they're trying to move the market with their optimism. It's kind of, if we build it, it will come. Like if we talk enough about a recovery, if we convince the markets there's a recovery based on our forecasts, then we'll will it into reality because they think that they have all this, power to sway opinion and confidence. And that confidence that is created by their own rhetoric is going to create the recovery that their policy fails to create. In fact, their policy is inhibiting the recovery. That's why I know it's not going to happen because as long as the Fed is stimulating the economy, it will never grow. It's a sedative. But, hey, Jim, we still haven't talked about your book. So when we come back, we want to talk about what actually is going on with your new book, The Death of Money, as opposed to the currency war, which I'm assuming is what killed money. Because, you have a lot of casualties in a war. And I guess in a currency war, the casualty is money, and that's what dies. And we'll talk about that after this break. We'll be right back.
To President Obama, Madam Pelosi, and all of the socialist econ professors across America. We're sorry. Peter Schiff is back on the air.
We are talking with Jim Rickards all the way from Hong Kong. His new book, The Death of Money, The Coming Collapse of the International Monetary System, due out April 8th. I'm looking at it now. Amazon.com, currently number 327 in books. Maybe we can edge it up a few notches from the Peter Schiff Show. And, Jim, if you ask me, money died a long time ago. Richard Nixon buried it back in 1971. We went off the gold standard. And what we have now is kind of like a monetary ghost. We have fiat currency, and that's not money. And it's about time that died. Maybe we can resurrect the real thing.
That's what I foresee in the book, Peter. The book, The Death of Money, is sort of a prequel and a sequel to the currency wars. The prequel in the sense that, you remember the first two chapters of Currency Wars were about this Pentagon financial war game done at a top-secret weapons laboratory outside of Washington, where I was one of the organizers, facilitators, and participants. That was in 2009, and a lot of people said to me, well, Jim, that was interesting, love that part of the book, but what were you doing there? So how did you get the invitation to come down to the Pentagon, help them plan the game. So what I do in the new book, I take the story of my involvement with the national security community back to 2003, not long in the aftermath of 9/11, and talk about the insider trading that took place ahead of the 9/11 attack. And, a lot of what I would call crazy conspiracy theories have been thrown around about that. The U.S. government planned it and all that. That's all nonsense. But these were al-Qaeda associates. In other words, terrorists exist in a social network. They have mother, father, sister,
right.
brother, safe house operator. That's where the leakage was. That's where the insider trading came from. It's very visible. I talk about it in the book. But what the CIA did was say, okay, if that happened, then if there were another spectacular attack, would there be more insider trading? Could you spot it? Could you track it down? And could you stop the plot and save lives? We worked on a strategic project. Yeah.
Was there actually enough insider trading, in leading up to 9/11 that it could make, that it would make a difference? Because there's so much, people are shorting stocks, going long crude oil. There's so much speculative activity going on all the time. Could the terrorists make that much of a difference?
Well, this is what I explain in the book, Peter. There's something called signal amplification. In other words, the terrorist trade itself was small, and you're right about that. But you know as well as I do, you're familiar with markets. If the market's up and the sector's up, and somebody comes in and buys a bunch of puts on United Airlines, and that's a bet that the stock's going to go down. So the market's up, the sector's up, there's no news, and somebody comes in and buys puts. What does the specialist think? He doesn't know. The specialist is not a terrorist, but he says, you know what, I'll buy some from my own account, buy some puts, in other words, bet the stock's going to go down. Well, then that crosses the tape. Some upstairs trader at a hedge fund sees it. He does some, et cetera. So by the end of the day, you might have 1 million shares traded. Only maybe 5,000 of those shares are actually terrorist trades. The rest are piggybacks. They're not illegal, but they're amplifying the signal. It would be as if, if you ordered a sandwich for lunch every day for 10 years, and then one day you called up and said, I like 500 sandwiches, the guy at the deli would know something was wrong. He'd say, why does Peter need 500 sandwiches today? He must be having guests. But the point is, that's the kind of thing. It sticks out like a sore thumb. Nobody was looking for it. Nobody before 9/11 was looking for terrorist traders. But you go back and look at the data, and a lot of people have. Academics have, researchers have. It's all described in the book. I hope the readers enjoy it. So that's the prequel. The sequel is to take the story of currency wars further into the future, exactly as you suggested. Currency wars have a lot of history. There were 5 chapters of history in there because I wanted to talk about gold, but if you jump right in, people tend, as well as I do, people tend to marginalize you and say, well, he's a gold bug or whatever. I thought if I use history to tell the story and show how until fairly recently gold was a big part of the monetary system, that would basically bring the reader along and see gold in a much better context. And now what I do, I take the story forward, look at the next financial collapse, make the point that, look, the next one is going to be bigger than the Fed. If the Fed had to print $4 trillion to bail out the system, and there's a panic or a crisis tomorrow or next year, they can't print another $4 trillion. Legally they can, but they're going to be way past the confidence limit. They will destroy confidence in the dollar. So the next crisis is going to be bigger than the Fed. That's going to go to the IMF. The IMF has a printing press. Not too many people know about it, but they have a printing press. They can print what they call special drawing rights, or SDRs. It sounds geeky, but it's pretty simple. It's just SDRs are world money issued by the IMF. It's another kind of fiat currency. It's not backed by anything. But basically will replace the dollar. People talk about the Chinese yuan. The Chinese yuan is not a reserve currency, and it's not even close to being a reserve currency. But the SDR, backed by the IMF, not backed by anything else, can be function as a reserve currency. Now, the question is, if you lose confidence in... Sorry, go ahead.
Who's behind who's behind the IMF? Why is anyone going to have confidence in that? All this back in the IMF.
That's a very good question. If you've lost confidence in the dollar, why on earth should you have confidence in something you don't even understand? I'm just telling you what the elites are going to try. Again, whether I think it works is irrelevant. The elites are going to try this. When I say elites, again, it's not a deep, dark conspiracy. These are finance ministers, academics, central bankers, the usual suspects running the international monetary system. They're going to try it. But it may fail also for the reason you suggest, which is, hey, if I've lost confidence in the dollar, why should I have confidence in SDRs? By the way, we're not going to have SDRs in our pockets. We're not going to be walking around with them. This will be world money for things like the price of oil, settlement of balance of payments. Probably major corporations will begin to state their books in SDRs. So it'll be for the big guys. We'll still have dollars, but they'll be like Mexican pesos. It'll be walking around money. It'll be a local currency. It just won't be the reserve currency. But if that doesn't work, we'll have to go to some kind of gold standard, because there's no central bank in the world that wants a gold standard, but they may have to go to a gold standard to restore confidence, and that's sort of where the book
it's
leads.
like, look, if the dollar collapses and I'm like Vladimir Putin and I got all this oil to sell, the last thing I'm going to do is take special drawing rights from the IMF. I'm going to want gold bullion or something like that. But
well,
hey, Jim,
you make a good point. Russia is a big part of the IMF. Russia's part of the IMF and the G20 and the BRICS. If we run them off the road, turns out we may need their help to run this SDR plan. So you're right, that may lead even faster to a gold standard.
Yeah. Hey, Jim, look, we got to hop. We're coming up to a hard break, but I know you got to go too. You're out there at your conference, and so I wish you the best, safe travels, my friend, and also good luck with your book, The Death of Money, The Coming Collapse of the International Monetary System. And, it couldn't happen too soon. Everybody else, Hour 2 of the Peter Schiff Show is coming up next, so stick around. We will be right back.